So, good evening, everyone. My name is Jonathan Tucker. I'm the Managing Director of Tucker Professional Corporation. Welcome to today's session. 5 tax-efficient ways to withdraw money from your professional corporation. For those of us who haven't met, I'm a CPA, CA, and our practice deals just with healthcare professionals. So I hope you find our presentation today to be of use. For those that are clients of the firm, some of this material you will recognize from our conversations and webinars in the past, but I hope that you'll find it useful. The genesis of tonight's topic came out of a number of conversations that I've been having with clients lately, and it's around the question of, should I pay down my debt since interest rates have gone up? And so that's the background for today's session. You can see on screen that some facts about what's happened this year, although it would be hard to miss it. But the interest rates in Canada have increased from 0.25%, this is the overnight rate for the Bank of Canada, to 3.25% in less than a year, which represents a 1,200% increase. And so now Canada has the highest policy interest rate among G7 countries. And debt reduction has been a question on many people's minds. And so out of those conversations and that topic and the events that we face, now many people are wondering, is it time to take out some of the money I have saved inside of my professional corporation and use it to pay down debt, or what should we do? Is now the time to aggressively pay down debt? Well, if you're a sole proprietor and you have savings that you can use to pay down debt, yes, now would be a good time to do that. Or if you have debt that is high in interest rate, like credit card debt, yes, you'll want to get rid of that for sure. Maybe, instead of definitely yes, maybe not so fast if you're incorporated and you have money inside of your professional corporation. If that's the case, then we'll want to take a look at some of the consequences of taking that money out to pay down debt and whether or not that's a good decision. Also, if it isn't just money you have inside your professional corporation, but you have investments, if you reach the conclusion that you do want to pay down debt, what's the tax cost going to be to in order to sell those investments? If there is a capital gain, pay the tax on it, although the markets have just been horrible this last year, so you might not find yourself in that situation. But those are 2 considerations to keep in mind. We're going to use a little case study for Dr. A as a frame or as a basis of reference as we look through and consider this evening. Dr. A operates through a professional corporation. That corporation is paying him a salary of $220,000 per year. That's by design. That's because at $220,000 in the province of Ontario, for example, the tax rate above 220, round numbers, is 53.53%. And so by design, his income has not gone into the top tax bracket. The facts around his situation are as follows. He has a mortgage of $1 million on his house. The interest rate now is 4.48% on that debt. He has a home equity line of credit of $200,000 for home renovation that he's just completed. The interest rate on that is 5.45%. He still has some debt from school, about $150,000 on a line of credit held personally. It has an interest rate of 5.25%. And then he still has some credit card debt that he's carrying a balance on. That has an interest rate of 24.99%, and it's unpaid. So that's the scenario we want to look at. Now, what we have as a result of the change in interest rates in the last year is now a very different scenario than what we had in the previous 12 months. And so you can see I've summarized the rates of interest for each type of debt on this chart. I've also included the tax rates. And we know from the previous page that he is just at the point where he's entering into the top tax bracket, which means if he takes any more money out of his corporation, then every dollar he takes out will result in additional tax to him of 53.53%. So what is this slide saying? Well, debt reduction will result in a pre-tax risk-free rate of return to Dr. A, meaning if he has to take money out, or let me put it another way, if he wants to pay down debt, he will have a rate of return on that payment. So he is paying on his mortgage 4.48%, as you can see. In his tax bracket, it's as though he was earning 11.73%. The line of credit he has from school, well, the interest rate on that's 5.25%. So if he pays that down, it's as though he's earning 11.3%. And look at that credit card debt. I mean, in his tax bracket, at the rate that he's paying in interest, that's actually pre-tax costing him 53.8%, staggering. You can see how we get at those calculations. I put the calculation in the bottom of the row. It's the interest rate divided by the after-tax rate of income. All right. Now, why is this such a change for us in terms of our way of thinking? Why are people saying now interest rates have gone up, I should be paying down my debt? I mean, why weren't we thinking this last year? Well, the reason was because interest rates were so low. And so if we look at interest rates, as you see on this schedule from last year, a mortgage you could get for 1.89%. Somebody in Dr. A's tax bracket of 53% would, if he paid down debt, be earning 4.1% effectively by paying down debt. 5.1 on the HELOC, 4.8 on his line of credit. And again, it's still a very high amount on that credit card. But you can see how people thought last year, why would I pay down debt? Why wouldn't I just carry debt? The money's not costing me anything really at 1.89%. Why don't I just put the money into the markets? And so that's what Dr. A did last year, and he decided to invest in GameStop for some of his holdings. And in hindsight, maybe that wasn't such a great idea. But again, this is why we are now thinking differently about paying down debt. It's the effect that interest rates have on our decisions in terms of where we put our money. Okay, so what's changed? Well, there's been a convergence of facts. Interest rates have increased. The markets, the stock markets have just gone into free fall. And not only that, but even if you were courageous enough to put money into the markets, or you still have money in the markets, there's the investment risk. Consider the option here, pay down debt, which is known, which is guaranteed, and you see the rates of return now that interest rates are up. That combined with tax rates shows you why paying down debt is an attractive proposition in certain circumstances. All right, let's return back to the fact pattern here and add a couple of more facts. He operates through a PC. He's earning a salary of $220,000 per year. The combined tax rate 53%. We've seen his debt. Now, a couple of other facts to throw in here. He has $100,000 sitting in the corporation's bank account. He has nothing in his own, really, so to speak, $1,000. His monthly living expenses, including mortgage only, and when I say including mortgage only, I mean, I'm not talking about payments on his HELOC or his line of credit or his credit card. I'm just talking hypothetically here about what his living expenses are, including his mortgage. And then he has a 3 to 5 year timeline in terms of financial goal of paying off the line of credit and also paying off the credit card debt. So that's the facts we're going to look at. All right. Now, if he's going to pay down his debt, the only place that he's going to be able to get money from is from his professional corporation. So how should we be thinking about the decision he's facing here? We know the current prevailing interest rates. We know the federal tax rates. We know that he will trigger personal income tax by taking a bonus from his PC to pay it down. Now, consider the following formula: the tax rate, which is 53%, the interest rate on his mortgage, which is 4.8%. If we do this calculation and divide the interest into the income tax rate, it will give us a break-even number of years. Now, stick with me on this, because this is the conversation I'm having with a lot of people. They're saying if they're in a top tax bracket or they can't have any more income because it will cost them too much in tax, but they're also concerned about paying down debt. How should you think of this? Well, in the column marked mortgage low, you can see $1 taken out of that corporation by Dr. A will cost him 53 cents versus 4.48% interest. So here's what I say to a lot of people: don't lose perspective just because interest rates have gone up, because here Dr. A could go for 12 years of paying interest at 4.48% on his mortgage before he would have spent more than he's going to pay in tax if he took the money out to pay down his mortgage. So 53% divided into 4.48% puts it into perspective. That's 12 years before he would have paid more than he would with tax, if that makes sense. Now, the credit card, that's a different story because the rate of interest is so high. He's got 12% or 12 years on the mortgage, where he's got 2 years on that credit card before he starts to pay more in interest on the credit card than he would in tax. So that's a different scenario to look at. So what are your thoughts on this? Well, I think that last slide showed that to take out funds out of his professional corporation would be a costly venture, and he could go for 12 years before the tax cost would have cost more. But if you'd like to see it in numbers, then let's walk through a scenario here. We know his mortgage is $1 million. We know the interest rate on it is 4.48% right now. When he got his mortgage, one of the terms in the mortgage agreement was that he could pay down any 1 year as much as 15% of the amount originally borrowed. So that's $150,000, let's say. Now, we also want to take into consideration that the mortgage is being amortized over a 20-year period. We know his tax rate. And if he were to take out $150,000 and pay down his mortgage by that amount, the savings and interest each year would be $6,720. Now, over 20 years, we've got to take the savings of that into consideration over the full 20-year period and then discount it back to today. If we do that, then the cost of that interest on that mortgage, the savings to him on that mortgage would be $88,511 in saved interest. So that's interesting to know. So here's the question: should he actually proceed and take $150,000 from his PC to pay down his mortgage? And if he did that, how much would he actually have to take to net $150,000? After all, $150,000 is his net pay, but we know he has to take more than that to cover off the tax. So this is where the analysis comes in. $150,000 is what he needs. His tax rate's 53%. So if we apply that, he actually needs to take out of his corporation $322,789 to net $150,000 to then pay down his mortgage. So the tax cost on that alone, recognizing that he's already earning $220,000 a year, is going to be $172,789. That's $322,789 minus the $150 he needs. So it's going to cost him $172,000 in tax to save $88,511. The tax cost, therefore, is $84,278 for him to take out money in his tax bracket, pay the tax, and then realize the savings over the next 20 years. So our conclusion, so long as income is subject to tax at the top marginal rate, Dr. A will not want to accelerate the repayment of his mortgage, since it will cost him more in tax than he will save in interest to do so. So far, so good. Now, I know the title of this presentation was 5 tax efficient ways to take money out of your corporation, but I wanted to start with this scenario to get you thinking along the lines of, if I need to take money out of my corporation, what would the tax cost be? So that you've got a case study in your mind just to see the factors and the numbers at work. Now, am I saying he shouldn't pay down his debt? No, I am not saying that at all. Here's what I'm saying. Presently, Dr. A grosses $220,000. And these are useful numbers for anyone who's taking this amount of income out each year out of their professional corporation. And I'm talking to those right now who are operating through a professional corporation. I'm not talking to a sole proprietor. I'm just talking about those who are incorporated. The tax plan for him is that he doesn't take out any more than $220 a year. When he takes $220 a year, he will pay tax and he'll pay CPP. The cost of those two is roughly $85,000. And so he will be left with $135,000 net each year. We know his living expenses, they're $7,000 a month or $84,000 a year. So he has a surplus that's available to pay down his debt each year. So he starts with $135,000 in his jeans. He knows what his living expenses, they're $84,000. He's left with $51,000 to pay down his debt each year. So our conclusion would be, instead of taking that big whack of money to pay down $150,000, use the surplus that he has each month, because he's earning more out of his corp than he needs to live on, to pay down first the credit card debt, because that's so high in interest, and then the home equity line of credit. Start on that. And that will take place over the next 3+ years, but he will be further ahead than if he were to take out a lump sum. Now, just for those that see that column to the right, I just wanted to give you these numbers so that you can keep them in mind, because oftentimes when we talk about gross pay and net pay, most people are thinking I need $5,000 or $10,000 to live per month. So I've broken that net pay down into monthly amounts. I always say this to people: if you're earning $220,000, you're going to net $135,000 out of that $220,000. $135,000 divided by 12 months means that every month you have $11,250 going into your bank account. If your living expenses are, in his case, $7,000 a month, he's got $4,250 each month he can use to pay down debt. That's the monthly allocation of the numbers that you're seeing under the annual column. So that's where those numbers come from. All right, I hope that's helpful. That's a little bit about how Dr. A is considering using the money that's inside of his corporation. So now back to the topic that was the title of today's presentation. If he needs to get more money out of his corporation, if you find yourself in the same circumstances, then let's look at your options. They're on screen. The first place I always tell people to start is reimbursing yourself for expenses every month. I'm going to spend a little bit of time on this because oftentimes I find that clients don't necessarily pick up all of their practice-related expenses. if you've worked with me for a while, you'll know that I'll explain how important it is to capture your expenses, because particularly as you earn a high amount of income, the value of a deduction is very high to reduce your income tax. So the first place to start is the reimbursement of your expenses monthly. And you might think, well, okay, how much is that going to be? It's going to be my cell phone. You'd be surprised. It could be your cell phone, yeah. Any professional dues? Are you making certain that those practice-related expenses that are flowing through either your personal credit card or your bank account are actually being picked up by your corporation? That's the first place to start. And if that's happening, then reimburse yourself every month. Because to the extent that you're seeing money coming out of your bank account every month for items like that, and you're not accounting for them or getting the money back, then your estimate of your living expenses is increased by those amounts, and it's artificial. If you're operating through a professional corporation, then you ought to be getting reimbursed. And if you get reimbursed, there's no tax consequences. You get the money, your corporation gets an expense, and you get the money to pay your credit card. It lowers then the amount of your expenses, or it lowers your living expenses each month because they're artificially inflated by that amount. The second way to get at money is through a loan. It might be a loan taken as a shareholder, or it could be an intercorporate loan. So we'll look at that. The third is a salary. You could take a salary. There's a number of reasons why you consider taking a salary. We'll look at some of those. You could also have a family member who's helping you in your practice, and they could get a salary. They won't want to get a dividend. That's the next thing that we'll talk about because of new rules, tax on split income rules that came in a couple of years ago. There's nothing to prevent you paying a family member, a spouse, or a child if they're a shareholder. There's nothing to prevent you from paying them a dividend. You're still allowed to do that. The only problem is the government says, well, if you do, we'll tax you at the top rate. For every dollar they get, they'll be taxed at 53.53% if they're in Ontario, for example. So salary can be paid out to a family member, but a dividend, it wouldn't be wise to. And then the fifth way is probably the most complicated, most complex, but can realize some tax savings, is through a corporate reorganization. And we'll talk about those. All right, so let's spend a little bit of time going over what I started to talk about, which is reimbursing yourself each month. That's the first item. Now, if you're incorporated, you incur expenses on behalf of your corporation every day. If you use your vehicle for work and you pay for gas, you pay for repairs and maintenance. If you go and buy office supplies and pay for it on your credit card, every day you're incurring expenses on behalf of your corporation. If you pay your professional dues and you don't use a corporate credit card, but you pay on your personal credit card, then you're incurring expenses. Those are some of the examples of expenses that you can get reimbursed for. So the first place I say to people is make sure every month you're getting the money back for expenses that you've been incurring personally on behalf of your corporation. I've given some examples though there as well for you to see. All right, now I'm gonna just walk you through this, because for those that haven't worked with me, let me just explain a system that I recommend people follow. Oftentimes, if you're incorporated, you will have been told have a corporate credit card and use that for expenses, and have a personal credit card and use the personal credit card for your personal expenses. We accountants do that. We say that to clients. And underlying that is our assumption that a client actually knows what an expense is. And so as I've worked with physicians, I've been amazed at how many expenses that could be deducted aren't. And so for that reason, I've come up with this suggestion for each of our clients and anyone who considers working with us, and it's this: don't have a separate corporate credit card. Just use your personal credit card and put all your purchases on that personal credit card. Why would I recommend that? Well, because you're healthcare professionals, you're not accountants. And if I say to you, put all your business-related expense on a corporate credit card, and you aren't able to decipher a practice-related expense, then there are deductions that go missed. So I say to people, put everything on a credit card, a personal credit card, and then every month when your statement comes in, go through, highlight that statement, identify the items that are practice-related expenses, and total them up, and then immediately transfer the money from your corporate bank account to your personal bank account. Reimburse yourself for those expenses. And then in our case, we say upload those credit card statements with your annotations on them so we can see where you've spent your money. Now I can tell you, I'll give you a couple of examples of things that I picked up lately that clients haven't, and my staff we train them to look for things and raise questions. A couple of weeks ago, I saw an Airbnb item on somebody's credit card. So in the course of conversation, I said to the person, tell me about the Airbnb purchase. And they said, oh, it was just our family vacation. We went and rented a cottage up north. I said, great, how was it? She said, oh, we had a great time. My husband and the kids, they had a great time, and I was on call all week. You were on call all week. Did you think of that as an expense? She said, no, I hadn't really thought of that. Why? I said, you would not have been able to be on call. You couldn't have been in the city here and been on call at that hospital up north. You needed a place to stay while you earned that income. The cost of renting that facility, those accommodations, were directly attributable to you earning that income. Now, if she was taking some time off that was personal, then in that case, we'd have to prorate it. That was one example. Another example I saw recently was a purchase from an art gallery. I said to the person when I was talking to them, I noticed that purchase. Tell me about it. What did you buy? And they said, oh, it was a piece of art. My wife and I really liked it, and so we thought we'd buy it. And I said, did your professional corporation pay for that? And they said, oh, that's a good point. Yeah, actually, I mean, it's in our home. It's near my home office, like in the room. I said, it doesn't have to be in your home office. A corporation can invest in art. It's an investment, just like investing in stock. If I hope I'm back. I was noticing a message on my screen that's saying my connection had been lost. So hopefully everybody can continue to hear me. I'll continue on. So my rationale has been explained for putting all of your purchases where possible on a personal credit card statement and using that as your expense report. And each time your credit card statement comes in every month, immediately total it up and transfer the funds from your corporate account into your personal bank account. Reimburse yourself. That's the first source of funds that is received on a tax-free basis. All right, I've talked about the process. Here's a credit card statement. Here's an example of somebody who's gone through and annotated their credit card statement. They've totaled the amount up in the bottom. They've then transferred $92.61 to their personal bank account from their corporate bank account. The only other item I would like to draw your attention, or the only other part of this that I'd like to draw your attention to, is oftentimes clients will say to me, or prospective clients will say, can you give me a list of the examples of things that I can claim? And I try to avoid giving people a list. It's not because I don't want to give you a list, it's I want to give you a concept. I want to give you the concept An expense must be reasonable. For an expense to be deductible, it has to be reasonable. And so an example of that would be a subscription to Rosetta Stone if you wanted to learn Italian, or conversational Italian classes. That would be another example. And so these are some of the examples that can be used to demonstrate the principle that an expense must be reasonable. If CRA were to look at those expenses incurred in Italy, they would say that is not reasonable. He didn't need to incur all that much in the way of expense, and certainly not his girlfriend along for the ride. So an expense has to be connected with earning your income, and it must be reasonable. Those are the two rules to keep in mind with respect to expenses. Your job, keep track of those. Your accountant's job is then to tell you what can and can't be claimed as an expense. All right, the second area to look at, the second means or method of accessing funds, is through loans from corporations. I'm going to explore two with you. One is a shareholder loan, and the other is an intercorporate loan. We'll talk firstly about the shareholder loan. I get this question quite frequently. People will say, I'd like to finish my basement, or the backyard needs some landscaping. I need to access some funds, or I have a line of credit and I'm paying more on my line of credit, and I've got money sitting inside my corporation. Can I borrow the money from my corporation and use it to pay down my debt, or landscape my backyard, or finish my basement? And so the Income Tax Act is quite restrictive on this. It is possible, but you have to think of the way CRA looks at this. They say this is a matter of equity, that if your next door neighbor goes to work every day and works for an employer, doesn't have the luxury of operating their practice through a professional corporation, they don't have the luxury of having access to money in the way that Dr. A has, then you have an advantage over that person. Dr. A has an advantage over that person. He can access funds anytime he wants, call it a loan, and if these rules in the income tax weren't in there, then everybody wouldn't have any income who operated through a professional corporation. We would only ever borrow money, because loans, unless absent provisions in the Income Tax Act, wouldn't be subject to tax in the same way that income is. Okay, so that being the case, then the Income Tax Act prescribes some pretty restrictive rules with respect to this. The money can be taken out, and so that can be done intentionally or unintentionally. I won't go into the unintentional. Let's just deal with the scenario in which somebody needs money for a down payment, or a purchase of a car, or a home renovation for RSP. That's the intentional use of corporate funds. They are permitted to do it, but the loan must be repaid within 1 year following the taxation year the money was borrowed. So let's say I have a December year end for my corporation, just to keep it simple. I took money out this month because I wanted it for a new car. And so I took, now cars are expensive, I took $100,000 out of my corporation to buy a car. The government says, okay, fair enough, Jonathan, you can use that money, but it must be addressed. That balance of money must be addressed by the end of next year, December 31st, 2023. And did you notice I said it must be addressed? I didn't say it had to be repaid, because while that is one of my options, which is to put the money back, I also could have my corporation declare a dividend for the full amount this year to wipe out that loan, or I could have it declare a dividend for half of that amount and wipe out half the loan this year, and maybe wipe out the other half next year. But you can see the Income Tax Act is not giving me a free ride here. It's not allowing me to access corporate funds and be able to use those as ever I want for whatever period of time I want. No, it has to be addressed, either repaid or taken into income by the end of the next fiscal year end of my corporation. Not only that, but while I'm using that money, if I'm paying interest on it, fair enough. If I'm not paying interest on it, and that's my call, I can say I'm going to take $100,000 out of my corporation, and it won't have any interest on it. I'm not going to pay interest. The government says, fine. That's a taxable benefit, because anybody going to the bank for money has to pay interest. You can't just access funds without paying interest. So we're going to calculate a taxable benefit for the use of those funds. Even though your corporation hasn't charged interest, you haven't paid it. If that's the case, then we're going to ascribe a taxable benefit to that. Presently, they use the mechanism they use is called the prescribed rate of interest. It's published every quarter, and as of October 1st, it just went up from 2% to 3%. So if I borrow that money from my corporation, either I pay at least 3% to my corporation, so to cover the interest, and if I do, then I'm not in receipt of a taxable benefit. But if I pay anything less than 3%, then there is a benefit which I'm receiving, and therefore I have to report that on my income and pay tax. The interest, incidentally, has to be paid or repaid or paid no later than 30 days after the end of the year per Section 80.4 of the Income Tax Act. Now, you might be thinking, okay, well, fair enough. Why don't I do this? Why don't I take 100 now? I got to have it taken care of by the end of next year. What if I, the week before December finishes, I'll use my line of credit. I'll put the money back into my corporation, so I'll wipe out the loan, and then I'll wait until the next week following year end, January of the following year, and I'll take the money out. Well, the courts have ruled on that, and CRA, if they find that to happen in a corporation, will not accept where there is a series of loans and repayments of loans. So that really the whole intent here is borrow money, pay it back just before year end, and then take it out again. So again, I just make that point in there that this is not intended to be used and abused by putting money back and taking it out. All right, so that is shareholder loan. Now let's talk about intercorporate loan. This one usually gets a lot of interest from people as well, particularly around real estate. People have money sitting in their professional corporation, a medical professional corporation, for example, and they'd like to invest in real estate, but they realize, listen, if I take the money out, then I'm going to pay tax on it. Is there any way I can get use of that money and not pay tax? And this is where the use of a holding company comes in and an intercorporate loan. So in this case, the MPC has money sitting in it. If it goes to Dr. A, he incurs tax on it. But if he loans that money across to a holding company, and the holding company then uses it to make investments, which it can do, then there is no tax consequence on the money that's loaned. So in this case, if he decided to buy a rental property, he would buy it with funds borrowed from his MPC plus funds supplied by the bank in the form of financing it. There would be a loan receivable from Holdco that lists or sits on the balance sheet of Dr. A's professional corporation. So his professional corporation is owed money by his holding company. And that potentially could sit there for years, no interest obligation required. And then at some point in the future, whether it's 2 years or 20 years down the road, Holdco sells that property, it sells the real estate, and then the proceeds of disposition from the sale of that property then are left in the holding company, and the holding company then repays the loan to the MPC. This is the structure known as a holding company and how it's used. And so if you've heard that before, but you're not sure what it looks like or how it works, there's an example. All right. So an intercorporate loan is one in which funds are loaned from one corporation to another, and it doesn't necessarily have to attract interest. It can be interest-free or interest-bearing. There's no tax consequences on doing that, and then the funds are accessible for investments, such as either buying stocks, for example, or buying real estate. I think that's what I'll leave that discussion and move on to then the third way of getting money out. So the first, reimburse your expenses each month. Secondly, you could look at borrowing money from a corporation either to finance the purchase of investments through a holding company or short-term shareholder loan. That is an option. And then we look at salary. So salary in comparison to what? So this is another option where we look at taking money out, but now we're getting into a means in which there is some tax involved and there's some tax planning involved. So salary as opposed to what? Well, salary as opposed to dividends. is typically how people think. And oftentimes I'm asked, well, okay, what should I take? Should I take a salary or should I take a dividend? And so that's what we want to talk about with respect to salary for this part of tonight's session, and just talk about some of the considerations. Not only can you, as an owner of your professional corporation, receive a salary for the work that you do, but it is possible to access funds in a tax efficient way by paying a relative, a spouse, a child. So long as the amount paid is reasonable, and so long as actual work is done. You can't just say, you know what, I'm gonna pay my wife $50,000 a year because she pays tax in a lower rate than I do. So if that's the case, that would not stand in the case of an audit with CRA. It must be reasonable. Reasonable defined as in, what would I pay to a total stranger that I would hire for doing that work? That becomes the measure of reasonableness. And then, is the person actually doing work? A couple of years ago, well, maybe more than a couple of years ago, it was the practice of accountants to recommend paying salaries out to kids, underage kids. And so there was a court case that came out that scared the tax community because we hadn't thought about this. And so the judge rendered a decision in which case the child was a minor, was receiving a salary, and in order to justify the salary, there was a job description that was given. The judge raised the prospect of a breach of child labor laws because the child was so young. Accountants had just looked at this as another means of income splitting and not taken into account labor legislation. So that as I say, sent quite a ripple effect and a chilling effect through the tax community. We stopped doing that. But it doesn't mean that salaries still can't be paid. For those criteria that I've said, it must be reasonable, the work has to be performed. The income that that family member receives will be subject to tax, but if your income is higher and their tax bracket is lower, then there is a real tax saving achieved. Now, how do I decide on whether or not it's going to be a salary or a dividend? Well, let me explain the difference between the two. To start with, a salary is something you receive in exchange for services rendered. You get up in the morning, you go to work, and during the course of the day, you do things for your employer. In this case, your professional corporation is your employer. And so there's an exchange of services, and so you're remunerated for that. That's typically how most people earn their income. They work for it. And so we as a society then, as a country, have decided that there are going to be certain social safety net provisions put in place for people that have to go to work. So if people have children, they have to incur childcare expenses in order to earn that income. There's that concept again, that link between earning income and incurring an expense. So in this case, if I have childcare expenses for my kids, then I can claim those against my self-employed income or my salary. Self-employed income is something I've earned because I've worked. Salary is something because I've done something, I've gone somewhere, I've fulfilled the requirements of a job contract. So the first consideration in salary is, do I have childcare expenses? Because if I have childcare expenses and I only have dividend income, I can't claim childcare expenses against dividend income. I can only claim it against childcare or against employment income. The second provision that's been now very popular, very common, is RRSPs. We as a society said, okay, we can't retire and live on Canada pension plans amounts. It's too small, so we better put a provision in place that lets people and encourages people to save money for retirement. We'll call it an RRSP, a Registered Retirement Savings Plan. And so for those that have to work, have to do something to actually earn their income, either they're self-employed or they're employed for an employer, then they can contribute a certain amount to an RRSP each year, and they can deduct a certain portion against the income that is earned income, active income, income they've done something for. If they only have dividend income, they can't do that. They're not permitted to contribute to an RRSP. And so for that reason then, that's the second distinction. First, childcare, second is RRSP. Third, if somebody wants to collect CPP, they have to have had the right type of income through the course of their career, self-employed income or employment income, to participate in the Canada Pension Plan. If they only have dividend income, they can't pay into the plan, and they can't realize the benefits that come from Canada Pension Plan as a defined benefit pension plan. All right, so those are some of the considerations. And then in addition to CPP, RRSP, childcare expenses, there's also other expenses such as employment expenses. There are a narrow range of expenses, but still people can still claim certain expenses against their employment income that they can't if they're only earning dividends. So those are the characteristics. So each year for each of our files, when we do tax planning at the end of the year, and we're right in the thick of doing this right now, we're asking clients saying, okay, tell me, do you have childcare expenses? Are you planning to contribute to your RSP? Do we want you to have CPP participation? All right, maybe we should look at salary or continue salary and do that next year as well. Now, if those are the considerations with respect to salary, then what are the considerations with respect to dividends? Well, I've kind of illustrated them as we've gone. A dividend is something that is earned, but not because you've done anything for it. For the companies that I own shares in that are traded on the stock market, I don't show up every morning at 9 o'clock to begin the day of work. No, I get a dividend because I own stock. A dividend is something that's paid out because I own something. It's an entitlement to something. And so in this way, a dividend is a payment made by a PC to its shareholders out of its profits. It's not for services rendered. And as such, it's not actually a deduction to the corporation. It's not considered an expense. There are different types, different categories of dividends. I won't bore you with the distinction between an eligible and an ineligible. Both are taxable. So if you earn them out of your corporation, or if you earn them because you own stocks on the stock market, you're going to pay tax on it. But there's also a capital dividend. A capital dividend is one of those balances that are maintained on your corporate tax return, and they can be paid out to people tax-free. You have these types of transactions if your corporation owns a life insurance policy, for example, and in the event of a payout for a death, the death benefit is paid into the corporation, and because life insurance proceeds are not taxable, then a capital dividend is paid out of the capital dividend account, permitting people to receive money out of their corporation on a tax-free basis. It is highly monitored by the government. Every capital dividend has to have an election and a board of director resolution attached to it. It has to be approved. And if it's not approved, then that dividend is converted into a taxable dividend rather than a non-taxable capital dividend. Another example is if you buy stocks, your corporation, I'll make that distinction, your corporation has an investment account and it buys stocks and it makes money on those stocks. Well, when it comes to capital gains, we only report half of the capital gain. If I bought Tesla, for example, and I made $1,000 gain on my investment in Tesla, I would only actually literally report $500 on my personal tax return or my corporate tax return. Capital gains are only taxed at 50% of the actual amount earned. And so for a corporation, that creates a problem because now Jonathan has this balance that he's made from the sale of Tesla, and it's sitting inside of his corporation. And how does he get it out tax-free? Because if he has to pay tax on it, if I have to pay tax on that whole gain, that is an unfair treatment to me in comparison to my next door neighbor who also made $1,000 but did it personally. And so a capital dividend account is used to enable shareholders to extract money out of their corporation on a tax-free basis. It's something you should be aware of and keep an eye on. And we look at it each year. Now, sometimes there's small balances and we won't go to the trouble of declaring a capital dividend each year. We'll let it build up. I saw one the other day. I think there was $680 in the CDA account. I thought it's not worth it. At this stage, we'll wait it out and wait till that balance accumulates because there's going to be legal expenses to minute that and draft resolutions and things like that. So there's costs associated with a capital dividend, but it is another method of getting money out of your corporation on a tax-free basis. Okay, That's the capital dividend account. Some considerations, as I've said, these dividends need to be reported, minuted in the corporation's minute book. They're considered passive, and therefore they don't permit the deduction of childcare expenses. The RRSP contribution room isn't increased because a dividend doesn't permit RRSP contributions, nor is the person receiving that type of income permitted to use that type of income to participate in CPP. Oftentimes, clients will have both salary and dividends so that we get both. We will access both types of income for specific purposes. And then, of course, the pros and cons of participating. And I've got, actually, the amount has now gone up to, for 2022 is $7,000. It's $34.9980, I think, for the employee share. And then the employer, the professional corporation, has to match that. So it's now $7,000 a year to max out your contribution to Canada Pension. Okay, we're getting there. We've covered off reimbursements, loans. We've talked about taking a salary and what distinguishes a salary from a dividend, who can get a salary. By the way, dividends, it wouldn't be wise to pay out a dividend to a spouse who's a shareholder of the corporation. And the reason I say that is because of the rules that were introduced a couple of years ago. Tax on split income is what it's called, TOSI for short. The government doesn't prevent you from paying a dividend. They don't, oftentimes I hear people saying, well, the government, now says I can't pay a dividend. Oh, you can pay a dividend. You can still pay a dividend. I could pay a dividend to my wife. I wouldn't, because she would be taxed immediately at the top tax bracket. So there's no point in doing that. I'm interested in ways of getting money out and not paying high rates of tax. That's not one way of doing it. So that's the dividend. Now we move to the section called Shareholders Equity. This is the most tricky area to extract funds. There are a couple of ways of doing it. Sometimes people have paid in amounts of money to buy the shares of their corporation. And so the money that they've contributed can be withdrawn. But as I say in this slide here, don't try this on your own. This is an extremely technical area, and there can be disasters if you try to extract funds and don't get proper accounting, tax, and legal advice on this. So a withdrawal of the original paid up capital is one option. The second is to strip out earnings that have accumulated over the years. Now, this can be an effective way of getting funds out, but it comes with its costs. In other words, it's fairly involved in terms of doing reorganizations. There's different methods for getting at the funds that you've accumulated inside of a corporation over years. And so typically, you wouldn't see entering into a surplus strip where there's less than $1 million, because the legal and accounting costs, the advisory costs, are such that it wouldn't be efficient to do that. But it certainly can be an efficient way of getting at funds at preferential tax rates. And so that's why I put that cautionary note on that slide saying, just because I mentioned it here, don't go now and look at your shareholder equity section of your balance sheet and say, look, I can take that money out. Jonathan Tucker said I can do that. No, I didn't say that. I said, get some advice on whether or not that even makes sense to do. Okay, we've covered the 5 methods. We've talked about whether or not it makes sense to take money out of your corporation in order to pay down debt. Have I raised any questions? Mustafa, have there been any questions that have come in?
Yes, there has been. First question is, can you buy a primary place of residence with a holdco and an incorporate loan?
Sure you can. Should you? No. And I've had clients who've done it in spite of the advice. Why wouldn't you do that? Well, for a couple of reasons. Firstly, if that's your principal rate place of residence, if that's your home, then the property that you buy, if it goes up in value and it's your home, it enjoys a principal residence exemption. That means if you buy your house for $1.5 million and you sell it for $2.5 million in a couple of years, that $1 million is tax-free because of the principal residence exemption. That exemption is available only to individuals is not available to corporations. And so if you buy that property inside of a holding company, you won't get access to the principal residence exemption. That's one thing. The second thing is if you live in that place and if you live in it and you don't pay rent, the government says, hey, hold on a second, you just use corporate funds to buy a property, whether it's a cottage, whether it's your home, and you're getting the benefits of that? No, no, no. We're not going to let that happen. So we'll assess a taxable benefit based on the fair market rental value of that property. So either you pay your corporation rent, so you're getting your own, you're using your own personal money paying rent to your holding company so that you don't get dinged with a taxable benefit. And if you sell that in the future, then you don't get access to the principal residence exemption. So those are a couple of reasons why I don't think it's a good idea. But to answer your question, can you? Yeah, you can. But I wouldn't advise it.
With the new surcharge on Visa and MasterCard, would it now be better to put all expenses through debit cards instead?
That's a great question. If you're using, well, if the credit card's a corporate card, then the bank charges or those charges assessed could be claimed as an expense of the corporation. If they're put on your personal card, then you might get into a situation where you would track the purchases. So if there's a charge based on that purchase, is it a practice-related expense? I went to Staples and bought some office supplies, so therefore I'm going to, and I used my credit card to pay it. Then part of the purchase price of those supplies is the credit card surcharge that I pay. So it would be written off that way. So, but to answer your question, to use debit, yeah, I would avoid that charge. I think you might be making more work for yourself because now you've got to track the expenses going through your personal bank account and your credit card. But that's a brand new question. Actually, that's a great question. And honestly, I haven't given that a lot of thought. So, but what I would say is this about that. Yes, I don't know the cost involved in that. But the reason I recommend using credit cards is because it's so easy to track all of your expenses. I don't pay for anything with cash. I seldom pay things with debit. I do have a couple of charges coming out of my personal bank account monthly, but I've switched all of the practice-related expenses into my corporate bank account. So things like life insurance and so on still come out of my personal bank account, but there's tax reasons for that. But I would suggest that your credit card is your means of ensuring you've captured all your expenses. But if you don't mind going to the trouble every month of looking through your personal account for expenses that could otherwise be transferred into your corporation, I suppose that's an option.
If there are professional spouses, should they have one professional corporation or operate through one?
Great question. We have clients that do both, and the way I look at that is I will determine what the projected earnings for each person is going to be in the future. So if we use one corporation, then if they're and by the way, it can't be a dentist and a physician. It has to be somebody who's in the same college. So I can't have, I couldn't have an engineer as a shareholder in my professional corporation, nor could a physician have a dentist in their corporation. So it has to be like professions and members of the same college. But assuming that's the case, I have a number of clients that use one corporation for that reason. But my thought process is this: how much are they going to earn in the future? And can we continue to take advantage with one corporation of the small business deduction? The small business deduction is the deduction that brings the tax rate in a corporation down to 12.2%, in Ontario, that is. So if I can efficiently manage the income on the first $500,000, which is what the small business deduction covers me up to, the first $500,000, that deduction applies. If I can do that, then yeah, I consider having two physicians, for example, or two dentists, and one professional corporation. And what if they earn more? Well, then it's still possible. So for example, I could go as high as $940,000 of income earned in one corporation and still stay within the $500,000 small business deduction limit. In other words, still continue to operate efficiently. My options might be a little bit curtailed because I'd have to make sure that each person received salary each year of a certain limit, but that's possible. But to answer your question, it depends on the circumstances. Sometimes what happens is we start out with one corporation and then down the road, we extract one shareholder out and have them create a second professional corporation. They then work in, and now there's two. But you don't have to necessarily default to two immediately.
Does it make sense to trigger losses in a corp investment account now that markets are low?
Well, I always answer investment-related questions by saying the most important criteria is the investment decision itself. It isn't the tax consequences. I oftentimes work with investment advisors, and I make it clear from the outset to say, your job is to manage the investments, my job is to manage the tax. So I'm always careful about giving advice about selling investments because of the tax consequences of it. I guess my first question would be, before you sell those investments, do you think that there's a future? Are they good investments that are just caught in a down time? In which case, then will you wish that you hadn't sold them in the future? That's the first priority in my mind. Now, if I've had gains in the past and I feel that those investments aren't going to recover in the future, that I'm really dealing with losses, then you can take the losses, sell the investments, realize a loss, and carry the loss back to the previous 3 years if you've got gains there, and recover some of the tax that's been paid on those gains. If there's no gains in the past, or you've got more losses than you had gains in the past, then the unused loss gets carried forward into the future indefinitely. So that those losses can actually represent an asset, if as strange as that may sound. But losses certainly can be valuable in the future. But don't do this because of the tax. Honestly, the tax is secondary here. Make sure you're comfortable that those investments don't belong in your portfolio in the future. And then if that's the case, then use the losses to your advantage as much as you're able to from a tax perspective.
They have a follow-up question here. Would it not mitigate the CDA?
Oh yeah, it could do. Let me explain that. Let's say in year one, I sold that Tesla stock and I made $1,000, and half of that $1,000 goes into the CDA because I only have to pay tax on half of it, on $500. So the non-taxable portion goes into the CDA balance. I can clear that out, but if I don't clear it out and the next year happens to be this year and I lose money this year, now the CDA balance that was there is now reduced by the amount of the loss. If I've lost more than $1,000, then I've completely wiped out my CDA balance. Now, you can late file CDA elections, but there's a penalty for doing that. And so that might be something to consider. But you raise a good point that if there are losses incurred in the future, then whatever CDA balance that you had then would be wiped out. And that's certainly a consideration. Yeah.
Regarding the loan from your MPC to Holdco, has this been challenged in court, and is CRA aligned with this method because any gains/income corporately, either at MPC or Holdco, will attract tax at some point eventually?
Yeah, no, I've not ever read of CRA attacking that structure. The intercorporate loan is done all the time. The capital gain, assuming there's a capital gain that's now in Holdco, then Holdco will pay tax on that in the future. So it will pay its fair share on any gain that it makes on investments. And then the proceeds that are generated out of that are then paid back. Whether or not there's been interest charged by OpCo to Holdco is a detail. If there was interest, then it's income to one party and it's a loss to another. If there's no interest, then there's neither interest income nor interest cost on that intercorporate loan. So no.
You mentioned that your life insurance is taken out of your personal account and not your corporation. What are the reasons for that?
I'll give you a thumbnail sketch, but this is a complicated area, and it gets into estate planning, and so your corporation could certainly pay for the life insurance premiums. Your corporation, in this case, has a couple of options. Firstly, life insurance premiums may be deductible. So if you're a dentist and you bought a practice, and in order to buy the practice, you had to finance it with money from the bank, part of the lending agreement would be a condition that there be life insurance covered on you so long as you owe the bank money. And that's only fair. You spend $3 million on a dental practice and the next day you get hit by a truck, then the bank is going to say, we're not going to be out $3 million. Where there's a condition in a loan agreement or agreements such as that require for commercial purposes that a life insurance policy be carried on the operator, on the individual, then those premiums for the pure cost of insurance can be deductible. Now, in this case, I don't have any obligations that require me to have life insurance. So then the question is, does it make sense for me to have my life insurance policy owned inside my corporation or owned personally? If I have it owned personally, then that means I have to pay the premiums out of tax-paid dollars, so I have to earn more money to then receive a net pay to then use it to pay my life insurance. Whereas my corporation could enter into an agreement to have a life insurance policy on my life, and it would then pay the premiums as a result. It couldn't deduct the premiums, but it could then pay for the premiums and just not deduct the premiums as an expense. Now, supposing tomorrow I get hit by a truck, then what happens? The corporation is now the owner of my life insurance policy, and the money is paid out as a death benefit to my corporation. That's not the greatest for my wife unless my will specifies that the shares that I own go to her, because then she becomes the shareholder, and as shareholder and a director, she could then have the money declared as a capital dividend and pay it out. It's tricky. And so I'm not saying you shouldn't do it or consider it. We do this with clients all the time. But oftentimes what happens is somebody has entered into a life insurance contract before they've incorporated, and it's probably not a large premium because it's oftentimes term insurance and they're young, and term insurance is generally pretty cheap. And maybe it's not worth the effort of just switching that policy over, because what's involved is you now have to have a change in beneficiary. So now the beneficiary becomes the corporation rather than my wife. The owner of the policy is no longer me. It's now my professional corporation, so I have to make sure that the owner is changed as well. If it's a whole life policy, there can be some tax consequences to that. So I might end up having a policy gain if I transfer the whole life policy into my corporation. So it's not an easy question to answer. It's an incredibly technical area, actually. So that's why I'm a little bit hesitant to address it. So I'm just saying I've given you just a flavor of some of the issues here, but please don't think that this is a complete and comprehensive answer. It isn't. This is a complicated area. What I will say is this: disability premiums should never be paid out of a corporation. Critical illness premiums should never be paid out of a corporation. The reason for long-term disability premiums not being paid for by the corporation is if you are facing a career-limiting injury or illness, and now you can't earn your living from your profession, then you will now be relying on money received from a long-term disability policy. You never get the same level of income from a long-term disability policy. They always pay you out 66 2/3 or 70% of what you would normally earn. The reason they do that is because they don't want to be taken advantage of, and they also recognize that in most cases, the benefits received will be received tax-free. So if I get 70 cents instead of earning 100 cents and paying 30 cents in tax, I have 70 cents. And so that's the reason that the benefits paid out in long-term disability policies are at a lesser amount than what somebody actually earns. Now, if I've paid for it in my corporation and I now am facing those circumstances and I start getting benefits from the long-term disability policy every month, those are no longer tax-free, they're taxable. So for that reason, I say everybody should make sure that they pay their premiums, their long-term disability premiums personally. Where I see people getting into trouble is they're part of a group. The money is paid into the group. There's a group of physicians, for example, or there's a group of dentists all working together. And for ease, they enter into an agreement, a policy that's a group policy. And then every month, the association has a bank account and they pay that premium on behalf of the doctors. And then the doctors just get what's left over. And the accountants don't even see it. We don't even see it because we don't even know there's a policy unless you know to say to the practitioner or to the client, listen, at the group level, do you know, is there any group policies that you're part of? And then we usually go to the administrator of those practices and say, okay, I need the details. What's being paid out above the line so that I can see all the expenses? And oftentimes there's a long-term disability policy that's being paid or a critical illness policy that's being paid there. We want to make sure we are aware of those and we do not claim those. That goes into either the person's shareholder loan account or it gets reported as income. So I hope that helps, but it's a tricky area.
What is a reasonable yearly salary to pay your family member to act as your billing agent / bookkeeper? My understanding is that it has to be the same as someone who is at arm's length.
That's exactly right. That's exactly right. What would you pay? What would you pay one of those providers to do that billing service for you? And oftentimes it's not much. So that sets the threshold. So then I say to people, okay, what else are they doing? Are they handling your calendar for you? Are they responding to emails? Do they do any bookkeeping? Do they go out and buy supplies? Do they act more like an office manager than just a billing agent? What do they do? And so then in that case, then you can come back and say, okay, maybe there's grounds to pay more.
Looks like that's it for the questions.
That's it. All right. Thank you everyone for your time and attention. I hope this has been of interest and help. There's my contact information on screen if you need to reach out, so feel free to do that. And then upcoming next month of November and December, our webinars will be a two-part webinar on the taxation of investment income. This is a really big area that is sadly misunderstood by many people. If you're earning interest income right now and you're thrilled by the fact that you're earning so much interest that you haven't beforehand, it is the most expensive form of investment income from a tax perspective. Capital gains are taxed at half the rate of interest income. Most people don't know that. So there's planning both individually as well as at the corporate level around investments. So we're going to dig into that a little bit and explore in the next 2 months the taxation of investment income from different perspectives. So make sure you watch out for emails on that. And once again, thank you for your time and interest in this. And just a reminder that what's been said in this session has been for educational purposes, and that's the reason that I have this disclaimer at the beginning and the end of our presentation, just so everybody's clear. Thanks so much for your time. Enjoy the rest of your day. Take care now.